Hello everyone and welcome to another episode of Forex Market Mastery. In the next 20 minutes, I'm going to show you exactly how professional traders read price action and why understanding candlestick psychology is worth more than any indicator you'll ever use. By the end of this video, you'll understand not just what candlesticks are, but why they form, when they matter, and how to trade them with actual edge in the Forex market. And if you stay until the end, I'll reveal the #1 mistake that causes traders to lose money on candlestick patterns.
Before we talk about patterns, we need to understand what a single candlestick actually represents. Because here's the truth most educators won't tell you. A candlestick isn't just price data. It's a psychological battle between buyers and sellers frozen in time. Every candlestick has 4 key components: the open, the high, the low, and the close. But these aren't just numbers. The open represents where the battle began. The high shows the maximum power bulls could achieve. The low reveals how far bears could push. And the close tells you who won that particular battle. A green or white candle means buyers won that period. They pushed price higher from open to close. A red or black candle means sellers dominated, driving price down. Simple, right? But here's where it gets interesting. The wicks or shadows tell you about rejected prices. A long upper wick? Buyers tried to push higher but got absolutely destroyed by selling pressure. A long lower wick? Sellers pushed down, but buyers came in strong and rejected those lower prices. These rejections are critical information most traders ignore. And remember, a 5-minute candlestick shows a 5-minute battle. A daily candlestick shows a full day's war. The higher the time frame, the more significant the information. A rejection on a daily chart is far more powerful than one on a 1-minute chart. Let's dive into how to read candlestick patterns and the psychology behind them. Let's begin with specific single candle patterns that actually give you an edge. Not theoretical patterns that look good in textbooks, but patterns that work in live Forex markets. First up, the doji. This is a candle where open and close are virtually identical. Psychology behind it is that buyers push price up, sellers push it back down, or vice versa. This shows indecision and uncertainty in the market. Momentum is weakening, especially after a strong trend. Traders are waiting for confirmation before committing. What does this tell you? Complete indecision. Buyers and sellers fought to a draw. Now here's the key. A doji by itself means nothing, but a doji after a strong uptrend, that's exhaustion. The bulls ran out of energy. After a downtrend, potential reversal signal. A doji doesn't mean reversal by itself. It signals pause, hesitation, and a potential shift depending on what comes next. For the hammer, this is one of my favorites. You've got a small body at the top and a long lower wick, at least twice the body size. What happened here? Sellers hammered price down aggressively, but buyers stepped in with such force they pushed it all the way back up. This shows rejection of lower prices. When you see this at a support level or after a downtrend, it's a strong bullish signal. Psychology behind it is sellers dominate early, price drops sharply, buyers see value and start buying aggressively, selling pressure is absorbed, bears lose control, bulls show strength and confidence. Note, a hammer shows rejection of lower prices and signals a potential bullish reversal, especially after a downtrend and with confirmation. The shooting star is the hammer's evil twin, small body at the bottom, long upper wick. Buyers tried to rally, got absolutely rejected. This appears after uptrends at resistance and signals potential reversals. Psychology behind it is buyers attempt to continue the uptrend, sellers see high prices as expensive and start selling, buying pressure fails, sellers regain control by the close. Note, a shooting star shows rejection of higher prices and signals a potential bearish reversal, especially after an uptrend and with confirmation. For the Marubozu, this is pure dominance, a candle with almost no wicks, just a long body. This shows one side completely controlled price from open to close, no contest, no indecision. When you see a bullish Marubozu breaking through a key level, that's serious momentum. Psychology behind it is one group, buyers or sellers, is in full control. There is strong conviction and confidence. The opposite side shows little to no resistance. Momentum is clear and decisive. Key takeaway? A bullish Marubozu shows strong buying pressure, while a bearish Marubozu shows strong selling pressure, often signaling trend continuation. And finally, the pin bar. This is similar to a hammer but can appear anywhere. The key is a very long wick, the nose, and a small body. This shows extreme rejection. In Forex, pin bars at major support or resistance levels are some of the highest probability setups you can trade. Psychology behind it is price moves aggressively in one direction. Traders reject that price level. Strong counterpressure steps in. Control shifts before the candle closes. Key takeaway? A pin bar shows price rejection and signals a potential reversal or continuation, especially at key support or resistance, with confirmation. But here's what separates profitable traders from losers. These patterns mean nothing in isolation. A hammer in the middle of nowhere is just a candle. A hammer at a major support level with confluence, that's a setup.
Now we're getting into the patterns that actually move markets. These multi-candle formations tell a story about shifting momentum and psychology. The first on this list is the engulfing pattern, the bullish engulfing. This is a two-candle pattern. First, you have a bearish candle showing sellers in control. Then, boom, the next candle completely engulfs it with bullish momentum. The second candle's body completely covers the first. What's the psychology? Sellers thought they had control, but buyers came in so aggressively they erased all that selling pressure and more. This is a powerful reversal signal, especially at support. The bearish engulfing works the opposite way. Small bullish candle, then a massive bearish candle that swallows it whole. Bulls got destroyed. At resistance levels, this is your cue to look for shorts. The morning star is a three-candle reversal pattern. First, a strong bearish candle showing downtrend continuation. Second, a small indecision candle, usually a doji or small-bodied candle, showing momentum is dying. Third, a strong bullish candle confirming the reversal. This pattern at major support, that's money. It shows the complete shift from seller dominance to buyer control. The evening star is the bearish version. Strong bullish candle, small indecision, strong bearish candle. This appears at tops and signals reversals to the downside. Three white soldiers. Three consecutive strong bullish candles, each closing higher than the last with small wicks. This is relentless buying pressure. When you see this breaking out of consolidation or off support, the trend is strong. Three black crows is the opposite. Three consecutive bearish candles grinding price down, heavy selling pressure that often marks the beginning of serious downtrends. Now the inside bar. This is often overlooked but incredibly powerful. You have a mother bar, and then the next candle's high and low are completely inside the previous candle's range. This shows consolidation and compression. Price is coiling. When this breaks out, especially at key levels, you often get explosive moves. In Forex, inside bars on 4-hour or daily charts are fantastic. The outside bar or engulfing bar. This completely encompasses the previous candle's range. It shows volatility expansion and often precedes big moves. Now that you've understood what candlesticks are and the psychology behind them, let's quickly dive into the practical application on how to make wise and accurate trading decisions with them.
Rule number 1. Never trade a candlestick pattern in isolation. You need confluence. What's confluence? Multiple reasons to take a trade. Here's what I look for. 1. The pattern appears at a key level. That means major support, resistance, a Fibonacci retracement level, or a psychological round number in Forex like 1.10000
On Euro USD.
2. The pattern aligns with the higher time frame trend. If the daily chart is bullish, I'm looking for bullish reversal patterns on the 4-hour chart at pullbacks. 3. Volume confirmation. If you're on a platform that shows volume, look for increased volume on the reversal candle. In Forex, you can use tick volume. 4. Indicator confluence. I personally use this sparingly, but an RSI divergence plus a bullish engulfing at support, that's powerful. Now, entries and risk management. Here's my approach. For reversal patterns like hammers or engulfing candles, I enter on the close of the pattern candle or on a retest. My stop loss goes just beyond the wick. For a bullish hammer, stop goes below the low. For a bearish shooting star, stop goes above the high. For continuation patterns like inside bars, I enter on the breakout of the mother bar's high or low. Stop goes on the opposite side of the mother bar. Take profit? I use a minimum 2-to-1 reward to risk ratio, but ideally, I'm targeting the next major structure level or using a trailing stop to capture bigger moves. And here's the most important part. Patterns fail. Even the best setups have maybe 60 to 70% win rate in ideal conditions. That's why risk management is everything. I never risk more than 1 to 2% of my account on any single trade, no matter how confident I am. Time frame selection matters too. Day traders might use 5-minute to 1-hour charts. Swing traders focus on 4-hour to daily. Personally, I find the 4-hour and daily time frames have the best signal-to-noise ratio in Forex. The patterns are cleaner and false signals are fewer.
Let's take this to the next level with concepts most educators never teach. First, multiple rejections increase probability. If you see 2 or 3 pin bars rejecting the same level, that level becomes incredibly significant. The third rejection is often the charm for a strong move away. Second, false breakouts and wick-throughs. Sometimes you'll see a candle break a key level with its wick, but close back inside. This is a false breakout or stop hunt. It's liquidity grab. Smart money triggered stops above or below a level, then pushed price the other way. These create some of the best trading opportunities. Third, where a candle closes on a level matters more than where it wicks. A candle that wicks above resistance but closes below it, rejection. A candle that breaks and closes above resistance, confirmed breakout. Wait for the close. Fourth, progressive candle sizes show momentum. If you see bullish candles getting progressively larger, that's accelerating momentum. If they're getting smaller, momentum is dying even if the trend continues. Fifth, be careful around major news events. In Forex, NFP, central bank decisions, and GDP releases can invalidate technical patterns instantly. I avoid trading candlestick setups within 30 minutes of major news, unless I'm specifically trading the news reaction. Now let me share the mistakes I see constantly that destroy trading accounts. Mistake 1, trading every pattern you see. Just because a hammer formed doesn't mean you trade it. Wait for confluence. Wait for the right location. Be selective. Quality over quantity, always. Mistake 2, ignoring the broader trend. Trading a bullish pattern in a strong downtrend is low probability. The trend is your friend. Trade with it, not against it. Mistake 3, using stop losses that are too tight. If you're trading a hammer, your stop needs to be beyond the low with some buffer. Getting stopped out by a single pip and then watching your trade go profitable is heartbreaking and avoidable. Mistake 4, not waiting for confirmation. Sometimes waiting for one more candle to confirm the pattern saves you from false signals. Patience pays. Mistake 5, overcomplicating things. Candlestick trading works best when kept simple. Pattern plus level plus trend equals trade. Don't add 17 indicators and confuse yourself.
Here's how to master this. Step 1. Spend 1 week just marking up charts historically. Find these patterns, note what happened after, and build pattern recognition. Step 2. Forward test on a demo account. Take screenshots of your setups, write down your reasoning, and review your winners and losers. Step 3. Keep a trading journal. Document every candlestick pattern trade. What was the pattern? Where did it appear? What was the outcome? This creates a feedback loop that accelerates your learning. Step 4. Focus on 1 or 2 patterns first. Master the hammer and engulfing patterns before trying to trade everything. Specialization beats generalization in trading. Step 5. Study these patterns across different Forex pairs: Euro-USD, GBP-USD, USD-JPY. See how they behave differently and which pairs you mesh with best.
So here's the truth. Candlestick patterns are not a holy grail. They're a tool, a powerful tool when used correctly with proper context, risk management, and discipline. The patterns themselves haven't changed in centuries because human psychology hasn't changed. Fear, greed, hope, panic, it's all there in the candles. The traders who make money aren't the ones who know the most patterns. They're the ones who deeply understand a few patterns, trade them in the right context, and manage their risk religiously. If you found this valuable, smash that like button and subscribe for more in-depth Forex education. Drop a comment below telling me which candlestick pattern you're going to focus on mastering first. And remember that mistake I mentioned at the beginning? It's this. Traders focus on the pattern and forget about the story. The market is telling you a story with every candle. Learn to read that story, and you'll never look at charts the same way again. Trade safe, trade smart, and I'll see you in the next episode where I will introduce you to support and resistance, the most important basics of profitable technical analysis. And if you missed our previous video on Beginner's Guide to Forex Trading, check the link in this video description and get yourself acquainted with the necessary Forex terms.